Money is a tool. It's one of the things that you need. It's one of the input costs. And yes, it's gone up, but so is gas.
So I've actually been investing in real estate for 10 years now, which is insane.
Let's talk a little bit about the elephant in the room.
Yeah, so if you're a fan of finance, this is such an exciting time. Really kind of get your popcorn out because it's every week there's a new story right now.
I mean, I've always heard that TD didn't have as much of an appetite to work with investors, but now they have some of the better rates, right?
Startup world can be very scary. We ended up going down in flames as well, kind of thing.
I'm a big believer in real estate as an asset class. I will until the day I die. Doesn't matter what changes in between. So, hey everybody, welcome to another episode on the YouTube channel. And today it's more of a podcast episode here. I'm super blessed to have Jacob Perez as a guest on our channel. For people who may or may not know, Jacob is one of the principals at Synergy Mortgage Group, and he's been able to help a lot of our clients out, a lot of our friends out in the past before. So, Jacob, thanks so much for making some time here to be on the podcast. And there's been some interesting things that have happened in the financial world here the past week or so, and we wanted to get you on here to help people understand it, and also to give people some assurance that there still are lending options out there, and people are still closing on real estate deals. So, thanks for making the time today, and thanks for being a part of our preferred service team.
Thanks for having me. Glad we're finally getting on one of these because I don't think we've done a podcast episode yet. So I'm sure there's going to be a lot of good nuggets here for the audience.
Very cool. So maybe just give the listeners a little bit of background there, Jacob. Like, how long you've been investing for, how long you've been a mortgage broker for. It's always great to see, even as like a realtor, if somebody wants like an investor-friendly realtor. I always tell people that it doesn't hurt to have an investor-friendly mortgage broker as well.
Yeah, so I'll tell you guys a little bit about myself for those of you who maybe don't know me at this point, but my name's Jacob Perez. I'm a mortgage agent, and we specialize working with real estate investors, helping them scale their portfolio 1 to 10 properties on the res side and then grow into some bigger things on the commercial side. Now, my personal experience in real estate investing is I was in the real estate investing space a long, long time before I was in the mortgage lending space. So I've actually been investing in real estate for 10 years now, which is insane to think about because I'm 33 years old. But probably most seriously, in the last 6 years, did I take scaling my portfolio very seriously. So, I had every job in the book from digital marketing to sales to project management. I did a master's in analytics, but no corporate career mattered in my mind because real estate investing was always my priority. So that's why I decided to make a shift into the mortgage space and find something that really aligned with it. And things have gone really well. I'm one of the top 0.3% producers across the country by statistics, which is amazing. And what's even better is just all the connections we make through all our amazing investor clients. And that's really kind of served me into new markets. So I used to work a lot in Ontario. Now we do a lot of stuff in Northern Ontario, and we're investing a little bit in Alberta as well. So really, sky's the limit once you get involved in this real estate investing world.
It's such a networking game, and it's very cool that you've been able to see this like synergistically help you as an investor as well. And I wouldn't be where I am if it wasn't for good lending and good resources and contacts and things like that. So let's talk a little bit about the elephant in the room. There's quite some interesting things that have happened in the States here recently with the Silicon bank and things of that nature. And I just want people to have confidence in the Canadian banking system. I mean, nobody has a crystal ball here, but what happened in the States is definitely a different kind of a scenario. So maybe just help people understand like what caused the run on that bank and causing that bank to close.
Yeah, so if you're a fan of finance, this is such an exciting time. Really kind of get your popcorn out because it's every week there's a new story right now, right? So the US banking system, the Canadian banking system, they're very different. We know in the US there are tons and tons of banks, more regional banks, whereas in the US we have majority of our banking concentrated through 5 major banking firms that are heavily regulated by the government. Now, I'm not going to pick on the US because there are things about the US lending system that I actually think are more responsible than how we lend here in Canada to some degree. But there's pros and cons to everything. So there's some things about Canada that are more stable, some things about the US that are more stable as well. But at a high level, I think it comes back to understanding the origins of money. And Corey, you've done a presentation on this that I listened to once. It was really, really good. But it really comes down to understanding how banks work, and they work on fractional reserve lending. So what that means is that banks lend out generally 10x or more of the deposits they have in branch. So if you come to the bank, you open a bank account and put in $100,000, that bank can typically go and lend out 900,000 or $1 million or invest that money or things of that nature. So what happens is you have these banks where, last couple of years in real estate, it's been really hot. Maybe they've lent out, billions in mortgage backed securities and different types of loan products. But maybe some of those people are taking their deposits out of the bank, right? Maybe their mortgage payments have gone up. They got to pull more out. Maybe they want to move to a new institution for better products. And now all of a sudden, this ratio that they're supposed to maintain, this fractional ratio, is now way out of whack. And if it gets so far out of whack, these banks can be shut down by the regulators, right? Now, if you look at Silicon Valley Bank specifically, obviously they were very, very big in these startup worlds. And some of their investments specifically that they did with the money they had was in this startup space. And for anyone who's worked in startups, you might know it just anecdotally, but if you've worked in a startup, you know how risky these startup businesses are and how quickly they burn up in flames. I personally worked for a startup before, and we had funding, and some of the things going on inside of the startup that I was told is normal and every company does this, we ended up going down in flames as well, kind of thing. So startup world can be very scary, and Silicon Valley Bank obviously wanted to kind of support their clientele that they were bringing in. So they made some bad investments in combination with deposits being out of whack with what they had lent out, and it just got to a place where they had to be shut down by the regulators. Right now, how does that impact Canada? Well, it impacts the US Federal Reserve and how they want to move their interest rates to combat inflation. So it's had a little bit of a good effect on the market because it's actually slowed the interest rate hikes in the US. And our interest rate hikes here in Canada are heavily tied to the US because what are we trying to do with these interest rate increases? We're trying to fight inflation. But if we don't maintain pace with the US dollar, all of a sudden our imports start getting more expensive, and that creates another stream of inflation entering our society. So reality with Canada, we are very, very much tied to the US. We can look at all these, inflation metrics in Canada, but it's almost as if we just need to look at the US because that's probably a better indication of where we're going with our interest rates.
Yes, and for, banks are supposed to guarantee deposits, but the thing with the Silicon Valley Bank was that a lot of these deposits were over the limit for the FDIC. Usually it's $250,000, but a lot of these deposits were over that. So it was kind of like a perfect storm when people all start pulling their money out of the bank and there's a run on the bank and the money isn't there, then it needs to get closed down. So kind of exceptional situation. We want people to understand what happened there. And now because of this, there's different demand for bonds in the bond market. And so what are you guys seeing for fixed rates these days? Like they used to be in the high fives and sixes, but I've heard that they've been coming down here quite a bit. I'm not doing any refinances right now. All my stuff's been taken care of a year or two ago, but what are you guys seeing these days?
So what we're seeing right now is fixed rates. If we're talking like, best products, right? So if you're the cleanest applicant, you qualify the best. The fixed rates are moving down into the high fours, sometimes mid fours. For some insured products, we've seen some 5 years at 4.29%. So they're moving downward, and the banks are being very cautious. Historically, when the bond market moves, the bank moves. Right now, what's happening is the bond market's moving, and the banks want to kind of watch it for a week or two and make sure this is for real and not a overnight activity that's going to change really quickly. So they're actually not passing down the savings as quickly as they normally do. But as we kind of continue to move here, we keep kind of trending downward. And I would just say be cautiously optimistic. We don't know that this is over or anything like that. The inflation data can change at any time, but it's certainly time to be cautiously optimistic.
Yeah, maybe if somebody is shopping or they're up for renewal, like I know a lot of brokers have told me, including your company as well, like go get a rate hold locked in, right? So that you have some runway with that sort of rate, because those are good rates compared to what we have been seeing.
Absolutely. A lot of people are just taking their existing mortgages and they're moving them into these high 4% interest rate ranges and just getting out of the variable for a 2 or 3 year period and saying, no, I can digest this payment and I can stomach it if my variable goes maybe a bit lower for a 6-month period before renewal. So that's a great way to get some stabilization in your payments and your portfolio again, if you're one of these people who does qualify.
Well, as you alluded to earlier, there's a lot of differences between the Canadian banks and the US banks, especially the numbers, right? Like, I believe there's over 3,000 banks in the States, and, we have more than just the 5, big banks in Canada for lending options. There's A lenders, B lenders, credit unions, but there's just because the States is 10 times bigger doesn't mean that we have, 300 or 400 options. I don't believe we have that much. But, what's working on the A side these days? What's working on the B side? I know you kind of took me through which of the A lenders are, more open to lending and which ones aren't. So maybe just let the audience know what you know a bit there, Jacob, and then what's working on the B side for people, what's not working.
Yeah, so I think when it comes to what's happening in the market, you got to be really careful about who you listen to because a lot of people are projecting their own anecdotal experiences and they might be a mortgage agent, who does 30 to 40 transactions a year. That's a really tiny sample size in terms of what's happening in the market. Maybe they've done if they do 30 40 a year, maybe they've done 6 or 7 in the last 2 months. So really like it's very anecdotal, right? Now, what's happening right now in the A lending space is not much has honestly changed at all. The only difference is that the interest rates are higher. So as a result, it's harder to qualify because that stress test is now increased significantly. Some other material changes we are seeing is that everyone's a little bit concerned about valuation. So appraisals are certainly taking a bigger emphasis than they ever have in the past. We saw a few months ago banks actually switch up their regulation on how they wanted the appraisal firms to appraise properties, putting a much greater emphasis on square footage and also putting a much greater emphasis on finding comparable sales, in the last 30 days. They don't want to look 90 days back and things like that because the market is so dynamic right now, right? So there's definitely some changes on the appraisal side. And then the other thing that's happening is there are some major banks in Canada who are starting to notice we might have some deposit issues as well. I'm not going to name any names, but that's happening in the industry right now. So there are some banks where they're artificially keeping their rates higher than the competition because they recognize they need to slow down and pivot strategy towards other areas of the bank. Whereas there's some other lenders in the A space who are recognizing this, who are saying we have a great opportunity to pick up market share, and they're coming to the table with ratio exceptions, with changes, with things like that to actually make themselves more flexible. So I think the A space right now, we're all kind of anticipating that there's going to be some changes coming down the line to regulation, but as of right now, there really are no major changes. Now, what's happening is there's another lending space, the alternative lending space, also known as B lending, right? And you have a lot of brokers who played in the A space who don't really have a lot of experience in the B space, and things are happening on their files, but they just don't know how to actually navigate this new landscape, right? So there's a lot of alternative lenders who are now coming to the table with 35-year amortizations, 40-year amortizations,
Oh,
doing things
wow.
where
I
they're saying,
remember I
okay,
haven't seen that. I haven't seen that in a long time. I can remember,
yeah, so, no, so there's
15 years
several.
ago, it was a lot more common.
Yeah, so there's several on the alternative side that are doing things like 40-year amortizations, and investors are saying, hey, I'll happily pay 6.7% instead of maybe 5.5% if I can get a 40-year amortization because my cash flow margin is now better, right? So there's some big opportunities that exist on the alternative lending side that maybe weren't there before as well. But yeah, I would say lending honestly is not in this bad space that it almost is made out to be. I actually see more innovation from the lenders right now than I've ever seen. It's really just valuations are scrutinized and for good reason. Like if I was the bank, I would want to, make sure these valuations are very good. And if you have a good case to make, they're going to listen to your case. So as long as what you're trying to do makes sense, there's good opportunity.
Yeah, and I think obviously competition is a good thing. When times are a little bit more challenging, it makes people, look at their businesses. I'm sure you have done this as well, and just said, hey, how can we continue to serve just as many people as we did last year? And it's always interesting that, again, you're right there, Jacob. For somebody that doesn't do a lot of volume, I'd say that you guys are like a Starbucks, right? Just lots of volume all the time. And you guys see all the different situations that are out there. And that's why I do believe it's important to work with a brokerage that does a higher volume than average number of transactions with real estate investors if you're a real estate investor. And we're not encouraging people to go out there and get higher interest rates on their principal residence. But as a real estate investor, that's one of your biggest tax write-offs. And for a lot of real estate investors, they just want to get through this interest rate environment. So that total cost of ownership with your mortgage, like principal and interest, is something to look at there as well. And it's always interesting that hey, different banks are going to have different appetites for lending at different times of the year. And I know I was discussing this with one of my one of the people that works at your firm, and it's hey, sometimes in Q3 or Q4, they just don't want to do any more mortgages, right? And, you know, each of the different big banks are going to have different stress test rates that they're, or percentages that they're going to make people qualify at. And that's okay. You know, there's other options out there. And it's kind of interesting. I mean, I've always heard that TD didn't have as much of an appetite to work with investors, but now they have some of the better rates, right? So it's just so important to be tied to the source. Someone like yourself who's literally doing so many files every single day, every single week at the brokerage.
And the other thing that's starting to happen too is that you're seeing a little bit of customer level pricing, which I think is a good thing and a fair thing. So if you're somebody where you have 100,000 in deposits at that institution and you have a banking relationship, you're seeing these lenders are more willing to make exceptions for those clients than in the past. It was really just based on the mortgage file. So we're seeing a more of an emphasis on the actual client profile right now. And for some clients, it's not as favorable. For other clients, they're getting kind of, the benefits they deserve that should come from being with a longstanding customer of an institution.
Tell us a little bit about your brokerage there, Jacob. Like when you guys have obviously grown, you guys are doing a lot of volume. Does that allow you to serve people a little bit better? Like maybe you get, you can get right to the source when it comes to an exception or things of that nature. You just have better relationships up at the top with the underwriters, and you might actually know people by name as opposed to like it just goes out in the ether and then you're waiting for a response back. Why should somebody
Absolutely.
work with a bigger brokerage like yourselves?
Yeah, so I think at the end of the day, whoever you're working with should provide, the service level you need to get through your transaction, your goals, things like that. But the benefits of working with a bigger brokerage is that we have higher level contacts within the lending institutions. So for example, one of the major banks our firm has been growing with like crazy in the last year. There's different levels of these banks. So you have an underwriter, that's the person you're sending the deal to who's approving or declining. They generally have some manager, a manager of some kind. Then there's generally a sales manager, and then there's usually the people who are at like the VP president level. So we're networking with the people who are at the VP and president level, and they want our feedback. They genuinely want it. So we're saying, hey, this is happening or this is happening, and there's times where they're saying, hey, the way our staff is interpreting this policy, I brought in like they'll bring in the person who wrote the policy and we'll leverage that person to get approvals and exceptions to fight with some of the people you're dealing with on the front line. So I think the more contacts you have in an organization, the more chance you have an exception, and also just the more files you're seeing, the more exceptions that exist. Everybody can kind of learn the cookie cutter regulations, but it's what exceptions will they make outside of the regulation, and you only know that through experience. So if you're dealing with myself, you're not just dealing with myself, you're dealing with, let's say, 8 full-time staff, because there's myself, there's 2 business partners, there's 4 full-time staff, and we're doing this every single day in the same office together, churning out 800 to 1,000 files every single year. Now, in addition to all that stuff, another thing you want to make sure is that you have the adequate support, right? So if you're working with a team, they should have multiple people in the process who can help out you. So if you work with us and I'm sick or something's going on, anybody on my team can pick up that phone, call you, and pick up a file from any point in the journey and take it to the finish line. Our big thing is we empower everyone on our team to be able to do every single step in the process. And that's really important because speed is one of the biggest values that you can provide to a client.
And I know towards the end here, we're gonna talk a little bit about commercial lending, which is really coming into its own these days. But we'll hold off on that. I want to congratulate you though. Like you guys are now licensed in Alberta, so tell us a little bit about that. Maybe that's more your brother spearheading that, perhaps. But I also know that you're maybe looking to dip your toe out that way as well. So
Yeah, so Alberta, so the thing I love about being a mortgage agent and the thing that makes our job a lot, I think, better sometimes than being a real estate agent is that usually we jump into these careers and we're driven by this passion to invest in real estate. Now, being a mortgage agent, I can work with clients anywhere. So if Hamilton, Ontario, where I live, is no longer the most profitable investment city and my clients are moving to Sudbury, I can go on the ride with them and take advantage and help them get financing in all these markets. So we really just move where the investors are going, and we've been doing a lot of deals out in Edmonton, out in Calgary, and different markets in Alberta. And there just recently in the last 6 months has been some regulation changes where they've stopped brokers from being able to submit out of province, and now they're
wow.
requiring licensing. So Alberta's been one of the hottest markets in the investor space. That's just the first out of province. That's the first province we've gotten our brokerage open in outside of Ontario, but there's going to be more. We're going to be going to New Brunswick, BC, Saskatchewan, all these other markets because that's where our investors are going. And that's where we're going too. So my brother and I were looking at a really really big deal in Edmonton. We love the fundamentals out in that city and the landlord friendly environment out there as well. So naturally, we just want to keep growing with our book of great clients, and that's out of province and that's into bigger deals too, like in the commercial space.
Tell us a little bit about the commercial space there, Jacob, because it's I've got a couple commercial mortgages. It definitely is a different monster. For people that are in the multifamily space, you technically can almost put a commercial mortgage on anything, right? But it does. I know you're mentioning earlier when we were talking before the show, it can get messier. I mean, these things are kind of more meant for certain sizes of loans, certain unit numbers, and then maybe we can even make sure that people are educated on the some of the CMHC products out there these days.
Yeah, so commercial financing, it's just the natural progression as an investor, right? You start with a duplex, you do a bunch of them. Eventually, you just want to try some new things. Even if something is very profitable for you, you might just want to take on a bigger challenge and things like that. So, commercial financing is a very different guideline, different process, different everything than residential financing. So at the high level, I'm sure a lot of people have heard this, residential financing looks a lot at you as a borrower and your personal ability to service a loan. They'll look at rental income, they'll look at some other factors, but it's not as big of an emphasis on that rental income. Whereas with a commercial mortgage, they're looking at the financial performance of the building, the potential performance of the building, and they're actually looking at you specifically as an investor. So you might find an amazing opportunity to reposition a 100-unit building, and all the numbers look amazing, and you have $1 million in the bank account, and you can go execute that deal. But if you've never done an investment in your life, the bank might look at you as the investor and say, hey, whoa, whoa, whoa. How are you going to turn over 100 units, coordinate 100 renovations? I know you have the money and I know the building works, but you don't have experience as an investor, right? So there's different creative ways to get into deals. Sometimes for very, very inexperienced investors who have a lot of money, you actually might need to bring somebody on your team who does have investment experience so that you can secure the really good financing on the deal. The same way an experienced investor might need to bring in capital into their deals. But when it comes to commercial financing, there's multiple different loan types. The ones that are most popular for us investors who love the BRRRR strategy are repositioning loans. And typically what they do is they look at the property and they go, okay, what will it be worth when I reposition it? What will it rent for? And if I'm going to do, $20,000 a unit, $30,000 a unit, whatever the renovation may be. And then is there a viable case to be made that this person can turn over the building, right? So if we're looking at a building in Alberta where the landlord laws are very friendly, a lender might have a lot of confidence that if I'm buying a 20-unit building, I can turn over all 20 units and they'll be willing to give me, maybe it's like 75% loan to value on the way in and a construction loan to actually finance all that renovation. And then on the flip side, they might look at that same 20-unit building in a place like Ontario, and they might say, "No, what? We're going to run this model off of you turning over 10 units, not 20, because it's a lot harder to turn over units in this area over the course of 2 years." So repositioning loans are amazing because they allow you to get in with a high loan to value on the property. The interest rates are going to be higher on these types of things, but they often come with a loan for the construction component as well. So just to give you an idea of a deal we just took down, we got a 65% repositioning loan on the building combined with a 15% vendor takeback. So total, we got 80% loan to value on this 18-unit building, and 100% of our renovation costs are going to be funded in the mortgage as well. So once we get through this building, next
Hopefully
steps,
people heard that 100%. That's
yeah,
awesome.
yeah, some, you can work with some lenders or maybe their interest rates are a bit lower. They'll do 50% of the renovation costs, things like that. So it just depends kind of what wheelhouse you want to play in, but we're getting 100% of the renovation looked at. We're looking at taking over a deal right now where it's a very, very big deal and the construction loan built into the mortgage is $1.5 million, right? So there's a huge appetite to take down these types of deals right now. And then outside of the repositioning loans, then it's like once you reposition the building, what kind of loan do you want to move it into, right? There's two types typically. There's a conventional loan. You just take it to a standard bank and get the largest equity takeout you can possibly get. And that's when the interest rates are a bit lower and maybe you're getting amortizations in the 25-year range or the 30-year range. And then the final step, or the best step, which a lot of people are trying to do in the multifamily space right now, is take advantage of what's called CMHC MLI Select financing. And the way MLI Select works, it's a program that's about 1 year old. And it's the government trying to incentivize a few things into our economy. They're trying to incentivize affordable housing units. They're trying to incentivize energy efficiency in these buildings. And they're also trying to incentivize accessibility for handicap and things like that. So basically the way CMHC works is that there's a point system, and if you achieve these tiers of points, and it's pretty black and white, this is the nice thing about it, they're going to give you loan terms that are more favorable depending on what tier and status you hit. So if you hit the best threshold, 100 points on the program, that means that you will get a 50-year amortization and you can get 95% loan to value if the loan debt services. So if you have a 50-year
Basically,
amortization,
never pay off the mortgage in your lifetime, probably.
yeah, but if you have a 50-year AM, it's a lot easier to debt service, right? So that usually
Of
means you
course.
can take an even bigger equity takeout. So the good thing about this is if you are looking in the commercial space, yes, you want to know your ARV. A lot of that stuff is similar as doing like a BRRRR on a duplex. But the one thing you want to do as well is you want to bring in an energy consultant and you want to know what strategic renovations do I have to do to hit the points on this metric system so that I know I'm getting my best loan terms on the refinance. So it's very similar to what we're doing on the res side. It's just different components in the formula.
And how do you find the appetite in the commercial space these days? We know the appetite with the on residential with A lenders, B lenders. It's feeling kind of tight right now. We got to be a little bit more creative, and some banks are just saying flat out no. But what's it like on the commercial side? I've heard it's bigger pendulum, and it's still swinging because they believe in the commercial space, and they're dealing with different asset classes that the value is in the asset. So are you guys seeing more due diligence or them asking for more than normal, or how's that going on the commercial side?
I wouldn't say more than normal, but I would say there's certainly the appetite and the lenders available for you expands once your loan size exceeds $1 million. Okay, if you're trying to get a commercial mortgage on a triplex, that could be very regional specific. Maybe there's one credit union in your town who's willing to apply a commercial mortgage on that and things like that, but you don't have a wide array of options. If you have a big purpose-built building, there is a huge wide array of private lenders, repositioning lenders, conventional banks that are all willing to get involved in the deal. So I would say that the asset really matters on the commercial lending side, and there's a lot of money going into that. And the other reason why there's a big appetite is the interest rates are higher. So when you're lending out a repositioning loan and the bank's getting 9%, 10% on it, and they don't mind taking over the building because they've already pre-underwritten everything, and they know if I take this over, this is actually a very valuable asset, right? There's a lot of appetite for these types of loans, whereas when we're on the A lending side and we're lending just above the bond market and things like that, the margins are very small, so the appetite may not be as big.
And people might have heard 9 or 10% and go, wow, that sounds high. But when you factor in that there's not going to be points on top of that, or you're only paying one set of legals because you're doing the mortgage anyways, you got to look at the total cost of the borrowing, and it's cheaper than private money. And I was literally just talking to someone the other day. They want a loan for something a little bit different. They got an opportunity to go do a bunch of construction for CN, and they need to pull $100,000 worth of equity out of their properties, and it was going to, because it was going to be kind of expensive. When we ran the actual cost of it, it was 15% per year. However, they're going to be able to go and make a couple $100,000 doing these contracts, right? So, but that doesn't sound too bad. The repositioning loan is not forever; it's for whenever you get the reposition done, which is awesome. So I think it's something that people need to hear, that hey, there are actually more options out there when you go bigger, and they're not looking at you as much; they're looking at the building more. And I have heard that before. I bought a property that was like high nines, and they're like, if it was only worth like $1 million, you'd open up to a different level of things here. So
And the other thing too with these interest costs, and this is just more a mindset thing for an investor, right? Often we'll run our budgeting, we'll run our pro forma, and we're like, okay, well, the renovation's going to cost 400,000 or 480,000. But when we're looking at the interest on the loan, we're like, oh my God, the interest on the loan is $9,000 a month, right? But if you just annualize that and lump it into your pro forma, this just becomes a lot easier number to digest, and you can actually break down the returns. Don't think of yourself going out of pocket every single month. Think about how much do I need to move in advance and have prepared for this loan term. The other thing too is generally when you're repositioning a building, you're not repositioning the whole building at all at the same time. You would like to be doing that, but it's pretty hard to do that. So yeah, maybe you have 5 out of 20 units vacant, but you got 15 rents coming in every single month, and that's offsetting a lot of the costs as well.
Yeah, people think this is super complicated, but really you just got to do a budget for, okay, what does it look like in, as a snapshot in time now, and just do that every single month until you get the property stabilized, and just look at the total costs of your borrowing, all the holding costs, all the acquisition costs. A lot of people just miss some of the numbers because they haven't done enough transactions, and it's not. If anybody's had some training in budgeting, it's not all that complicated. So money is a tool. It's one of the things that you need. It's one of the input costs. And yes, it's gone up, but so is gas. Fossil fuels and everything else have gone up here too. So, you basically got to make sure that you run your numbers on every deal and make sure that it does make sense and that the rents will support it and things of that nature too. So,
And people are dying to get into deals. It's just that maybe the network you're in right now is the network where everyone's the active investor. And how do you get yourself into the network where you have more of the passive investors? Because I can tell you right now, if you have a slam dunk deal and you need 2 million or 3 million, that money can come in the snap of a finger in the right circles. But if you're always in the active investor circles, sometimes it's a bit more challenging because we're all chasing sometimes the same thing.
there you go. So again, another reason to be in touch with people that work with money every single day. So as we round the corner here towards the finish line there, Jacob, like what's next for you, for your brokerage? You already mentioned a little bit about some of the deals that you're looking to take down. Congratulations on your success here this year. I know you've already taken down some other deals. If it's not a 100 unit deal, there's definitely some 20 something unit deals out there. So congrats on that. But where do you see your brokerage going here in the next year or so? Obviously going to different provinces, but
Yeah, I think just continuing to grow and continuing to find new ways to serve our clients, right? Right now, we're doing so much work on the back end to take administrative work off of our staff so we can have more and more face time with clients. So we're hiring more people right now. We're bringing on more agents in the brokerage, and we're completely revamping our tech on the back end. So that's been one really exciting thing that we're doing right now. But I think it's really moving into new loan types. I'll be speaking, I think alongside yourself. I don't know if we're announcing this yet at multifamily conference this May. So really looking forward to being there. We're going to have a booth and looking forward to meeting a lot of clients in person. But I think moving forward, you're going to see a lot more content from Synergy Mortgage Group, a lot more dedicated webinars for people at all different stages in the investment journey. And I think now we've gotten a huge taste of short form content. I think people want the more dialed in, detailed content, long form again. I think that's where we're going to start to move in the new year.
I hear you, man. Well, I just did a Facebook post here about my YouTube channel. It's about 13 months old. It's a beast, but you don't have any kids, man. You'll be able to handle it. And yeah, we're doing monthly webinars too. We should collaborate as well. And I'm super excited about the multifamily conference. They just put my picture up on the website the other day. I had to pick a different color suit so I didn't look like you guys wearing a blue suit, but definitely excited about that as well. Just seeing so many hundreds and thousands of people in one place in one weekend. And just being able to serve more people. I think it's awesome because I'm a big believer in real estate as an asset class. I will until the day I die. Doesn't matter what changes in between. So I want to appreciate you for your time here today, Jacob. But what's the best way for people to get in touch with you and to reach out to you? I know you're pretty active on all different platforms, but what are the best ones?
Yeah, the best way by far, hit me on Instagram at Jacob Perez 10. My girlfriend's always like, why are you always on Instagram? I'm like, I'm talking to the investors, leave me alone, right? So Instagram is definitely going to be the best place to reach out to me. We can schedule a call, chat. I'm pretty liberal with my calendar, let kind of pretty much anybody in there. If it's mortgages, just want to chat, investing, maybe it's career advice. Looking forward to connect with as many people as possible.
All right, everybody. Well, there you have it. We just had a great episode here with Jacob Perez. And our long form podcast is usually the deal maker, action taker. So Jacob is definitely both here. If you haven't subscribed to the channel, make sure that you hit that subscribe button. Drop a comment down below. What did you learn from the episode today? And if you've already listened to the very, very end, my hat's off to you. Until next time, everybody, keep making sure that you're running your numbers. Buy smart real estate. We'll see you on the next one.